Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in there, take a look, and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, deeper into individual companies, deeper into my opinions about those companies, and you can see how I'm positioning for the commodity bull market. We've got Oren here. Oren says, few will understand the power of this chart of the historic Dow to silver ratio. I'll have to do an entire video explaining it. So he's got on log scale the Dow to silver ratio, and what I have found is you need to understand the market conditions that is going to push silver higher against the Dow Jones. In this case, the ratio drops. And every time these guys have dropped, there are things that have occurred every single one of these drops that are basically in alignment. This was a big inflationary monetary boom. This was a gold repricing back in the 30s. This here was another real estate cycle boom, which had a large decline in the dollar. So, what occurred there is they raised interest rates in this general area here, and then they lowered them um, because of the slowdown in the tech sector. And I have a feeling that we're doing the same exact thing right now. We've got this big blow off tech boom. We had all that stimulus that came into the system in 2020. They aggressively raised rates. And then what happens after that? Things start to slow down. Once you get that slowdown, things get felt in the system, whatever those things are. It could be liquidity tightening, banks having problems, it could be all sorts of things. Then they see that in the system, they lower rates, the dollar drops, and then boom, blue arrow. So I think something similar is coming like that, and it seems very similar to the tech crash pullback. I think something like that's going to occur again. What it feels like, at least. Non-biased, honest evaluation here. Are these charts bullish or bearish? I will let you know towards the end of the day today what sector it is. So I've got these charts here. This looks like an expanding megaphone pattern that's at the bottom. It looks bullish. Higher lows, higher highs, outside of these two highs there. We've got a big move early in from about 2000 onward to about 2005. And then we've got another break of this long-term resistance line. That looks ultra bullish. And then we've got this guy here, which is stair-stepped up, and that's broken, retest, and it's running higher. That looks incredibly bullish. So all of these things look bullish, in my opinion, when I look at it. And some people are saying, bullish, bullish, bullish. Everyone's saying bullish. And you know what it is? They are home builders. Every single one of these are home builders. So when you strip away your biases and all you do is you look at charts, these are all home builders, and everyone is saying that they look bullish. Then why does everybody think that? Why do a lot of people think that we're going to have a housing market crash when the home builders crashed before the last market crash? Last market crash, they pulled back in 2005. They peaked in '05 and they pulled back '06, '07. They were already crashing in '08. Everything was blown out of the home builder market by 2008. Look at this. This is a shoulder head shoulder topping pattern, and it blew all the way down in 2007. And we were already down here in '08, and that's when the crash occurred, was '08 in the stock market. Your leading indicators are not indicating a slowdown in the housing market. And that's where I have to disagree with everyone. They are using lagging indicators. They are not paying attention to how money is being positioned in the market. and they're making up narratives that don't support the evidence of how people are positioning in the market. I gain my evidence from positioning in the market, like these charts. That's why technical analysis is one of the main things that I look at. And my guess is that these charts will go up when interest rates drop and the dollar drops. That's my guess. Now everything isn't set in stone. It's not 100% in the bag, but that's just what I've seen in history. And then you just play the statistics and whatever's in favor. So if it's a 70% chance, I play the 70% chance. I try to take an unemotional approach, put the statistics in my favor. I don't need to win every single time if you're playing with asymmetry. I only need to play and win a few times. And I can lose a whole bunch. If you win and you played it in the beginning of this bull market and you rode it all the way to the top here, that's a big win. Some of these went up 10, 20, 30, 40, 50, 100 times in that move. I don't need too many wins at 20, 30, 100 times with too much money in it. Crude oil versus other sectors, I thought this was kind of interesting. So I had crude oil versus uranium futures, and that looks good for crude oil to outperform, as weirdly as that is, and it's at a cheap location. You got crude oil versus silver, and I know everybody is oozing over silver, myself included. But this does look bullish. If you were to hit these trend lines in through here and then hit the bottoms here, then you've got another trend line through here. This is a falling wedge that's broken out of, and we're doing a retest. Is there some sort of possible way that crude oil absolutely decimates silver? I don't know. I mean, I'm trying to figure out ways to explain why the charts are doing what they're doing. We won't know until after that occurs, and then we look backwards to explain perhaps what is happening. But there's the possibility that crude oil could do some crazy stuff. There's possibilities that silver could do crazy stuff. There's possibilities that they both do crazy stuff at the same time. And maybe what we're charting is the dollar is about to make a very big move lower. And that very well could be the case. Maybe that's really what's driving it all. This is crude oil versus the S&P 500. Falling wedge broken out to the upside in 2021. And then we consolidated again in a falling wedge that's probably going to resolve upward at some point. So crude oil is about to outperform S&P 500, and crude oil is about to outperform the Dow Jones with the exact same setup as it was against the S&P. It's a falling wedge, three-hump consolidation, breakout, three-hump consolidation. We're just waiting for the breakout here. But still, it's very bullish. Now, here's the thing. We've got an inverted yield curve that's about to uninvert. The question then becomes, well, what do you weight more than the other? Well, if the charts suggest that they are going to go higher and the positioning's there, then I'm not exactly sure why they are lowering rates. No one knows that. It could be from a debt perspective of the United States, and they need to lower rates for some debt reasoning, which then would send everything to the moon if it's because they're gonna lower rates and the dollar's going to crash. Could be a potential possibility, but I don't know yet. We won't know until after it occurs. Crude oil versus gold. Charts look good for crude oil, although gold and silver are in the right market conditions to do very well. Gold to oil ratio is about 1 ounce of gold to 30 barrels of oil, which is really cheap for oil. And that's generally where I buy oil. But this is a falling wedge, the three-hump consolidation for crude oil divided by gold. We've broken out of that falling wedge to the upside. We've consolidated again in a falling wedge three-hump consolidation. We're right at the tip here. We could resolve upward where crude oil goes up against gold, and gold's going up also. Gold goes 4,000, and I'm just going to throw some numbers in here, guys. And this is just hypothetical, okay? But let's say gold goes to 3,500, and I divide it by 6. That means oil could do something like $600 a barrel. And I know people they can't wrap their head around that. They say, well, how can people afford that? Like, I don't know. I mean, at some point, the question then becomes, how are people going to afford anything? Are they going to afford food if the dollar were to drop like a rock? And maybe that's what occurs. I don't know yet. Here's crude oil zoomed in. There's your one hump, two hump, third hump. And we're right at the tip here. And we basically are right at that breakout. Zoom in again, and there's the breakout and then a potential retest here. And I know I cut this one off, but that was just seems like an overthrow right there before it turned. So hit, and then a bunch of hits through here. So again, I'm very curious to see how this plays out here. Very curious. I am positioned for both of these to go up. Now here's emerging markets. Generally, when the dollar drops, emerging markets starts to light it up. That generally occurs when interest rates fall, the dollar drops, and then we should be seeing positioning in emerging markets today if that's going to occur. Because big money is going to front run. They know what the Federal Reserve is going to do, and it's going to front run everything. So emerging markets, look, we're already moving up. That dollar's starting to drop, and here we go, starting to move up in emerging markets. Emerging markets, last time they had that dollar drop was '02 all the way to '07 or so, '07, '08, and then I think eventually it worked all the way to 2011. This went from like $10 all the way up to $52 in a few years time frame. Big move. I think a big move's coming for emerging markets. Here's EWZ. This is the Brazilian ETF. You can see that we were right on support here. And we broke out, but rates went up recently. And now they're starting to head down. I think this is ready to just rip. EWZ, at the bottom of 2002, was about $5. It went all the way to a peak of $95. This is an ETF. This is crazy. There's so many opportunities out there. Here's Canadian dollar or Brazilian dollar, falling wedge, and it broke to the upside of this falling wedge, and it's just been moving sideways. Sometimes it moves sideways. And we've also got the Canadian dollar in '02, it ripped higher. We had three hump consolidation, and this almost looks like a platinum chart. And why do they all look similar? It's because the numerator is not the problem. The denominator is. The denominator is the US dollar. That's what's going to get hit. That's what's going to cause everything to go up. Canadian dollar is going to rip because of the dollar and rates, in my opinion. I've got regional banking ETF, Livermore accumulation cylinder question mark for regional banks. Here's KRE. We got 1, 2, 3, 4, 5, 6, 7, and we're starting to work our way on up. What does that signify? I already told you above, the home builders look really good. And who makes loans against those new homes? The banking system does. Yep, regional banks. And they're sitting on a bunch of bonds, but what happens to those bonds when interest rates go down? Well, they go back up. Their losses won't be as big, and they're going to be able to make more loans to the real estate market and probably make more money, loaning more money as interest rates come back down. I think they're all interconnected. Everything on here is interconnected. They all have these big, like 1, 2, 3, 4, 5, 6, 7 patterns here. Very similar to some of the home builder stocks. So investments and when they do well in the business cycle. And we can use some of this information and tell us kind of where we're at in the business cycle. So we've got early bull, mid bull, late bull, and then we've got early bear, mid bear, late bear. And then we've got this economic cycle that is delayed behind it. So the stock market cycle is first, the economic cycle is second, and then it moves around. So we can look at these numbers, and these are the sectors that do well. So in my opinion, I think 4 is about to do well, financials. But here's the thing. We might have already cycled back down and utilities could fall out of favor. And I think technology is going to fall out of favor, perhaps. So that's going to be on the back end. So the front end, late bear and early bull, is financials. And that's starting to move on up. Emerging markets, too. And I know it's not on there. 11 is precious metals, and that's located here at the top. So what is going on here? How do we have financials and precious metals about to go up at the same time? We have basic industry. We've got 5 technologies over here. We have 7 capital goods. We have energy as number 9. Number nine's up with precious metals. So precious metals and energy move together in a late bull top. So are we in a late bull top? Potentially, maybe. What makes this difficult is they threw this stimulus money right in the middle of the cycle. And I think it messes with the cycle to some extent because they had to raise rates so fast from artificial inflation that they injected, which makes it difficult to know exactly where we're at in the business cycle. And I think people just fly right over that. Like, because the business cycle, it's generally driven by the real estate cycle. And with them romping rates up so fast, it obviously has slowed down the real estate cycle. But that wasn't an organic, it wasn't organically driven. It was an artificial stimulus and an artificial move of rates going up. It's all artificial. It kind of like muddies the waters to know exactly where we're located in the economic business cycle. Nobody talks about mid caps, but real estate and financials are leading. And that's what I was talking about, financials. And so when we look at this, the 1 month here, we've got real estate, financials, but I think those are also the most sensitive to interest rates. And that's what I think is going to drive. Energy's been lagging here. And then you can see energy's lagging here, but on a 6 month, energy was doing incredibly well. Energy, and energy, utilities, utilities. And now those are kind of switching and going downward. So it's like we're going through this cycle at warp speed through here. It's like we just went through this. We've come back down like really quick, and maybe we're coming through something else into a new cycle upswing. We'll see. And that's what makes it really difficult because we don't know the reason why they are lowering rates. We don't know if it's for political reasons. We don't know if there's actually a problem in the banking system or something where they have to lower it. And then maybe there's some fallout behind it. But historically, if you look backwards, an uninversion of the yield curve and the lowering of rates generally ends up in a slowdown in the market because we're coming downward and they're lowering rates to try to re-stimulate and soften the fallout. Metals and weekly price performance. So tin has been the big winner last. Gold and uranium. Palladium was the one that fell the most. Nickel, platinum, aluminum, zinc, copper, small downside there. EXK, backdrop of silver, are getting better by the day, moon soon. Well, it's already kind of mooning, to be honest. And we'll see. And gold and silver do really well. If we go back to this, precious metals do real well at stage 11, late cycle. But so does energy. And they both look really good. So perhaps we're going to get a big move in energy and precious metals. Perhaps. Basic industry is number 6, which is right before it. Coming on down, we've got by popular demand. Here's the oil price chart, 1861 to 2020. I posted yesterday in log scale. X the U.S. Civil War and X World War I. When West went off the gold standard, oil was essentially unchanged in price on net for 104 years. From 1867, $2.41 to 1971, $2.24. When the USD gold tie was cut again in 71, that is when we went way up in oil price. What is occurring is the denominator, the dollar, is losing value. And these swings in oil prices for sideways motions up, sideways motion is up, that's just how much money is injected into the system and when. And during certain periods of time when interest rates go up, that money gets seen in energy stocks and in energy and commodities. Because all the money that goes into the system rotates into commodities and precious metals. That's when the money in the system is seen by those assets. And the Federal Reserve doesn't want that money to be seen by these assets because it causes inflation in the consumer price index. They can't do anything about it. They want the money to be over in technology stocks, and they want the money to be in crypto because it's basically an intangible asset. It's just fictitious things. So if those prices go up and soak up liquidity, it doesn't impact the consumer price index. Now, here's something about copper: massive CAPEX intensity for new significant copper mines, and the uptrend will continue due to longer permitting timelines, strict ESG measures, and lack of infrastructure, more studies, local opposition, and water restrictions. So this is CAPEX. Look at the CAPEX go up. The one thing that I think is a really big driver is also ore grades. Ore grades have been declining rapidly. And as ore grades decline, the intensity of energy usage per ton of copper goes up exponentially, or CAPEX goes up exponentially. And this is going to keep going up and up and up exponentially because of inflation and because of ore grades declining. So this is CAPEX intensity per KTPA. They're basically saying per ton of copper or per unit of measure, whatever the unit of measure is. And we are moving on up. It says, are you seeing what I'm seeing? Silver bounced off its rising trend line, which has broken, regained, and now successfully retested. Coupled with the political upheaval, it can really catch fire now. Well, I wouldn't focus so much on, say, a trend line like this. What you want to focus on is the market conditions for silver to go up in. And that's what I would focus on. Why is it going up, and when does it normally go up? Then look at the market conditions, and as long as you have tailwinds behind the asset, then you want to be invested in that asset, irrespective of what short-term price movements look like. We could also have 1, 2, 3, 4, 5, 6, 7, an accumulation cylinder that is created, and we're ready to break that to the upside. So could also have an accumulation cylinder with silver. Grady says, as I've been saying, I think it's time for an epic move again. Said earlier this year that this ratio was bottoming. It did. It means this chart is now reversed to the upside, and that means silver miners will outperform gold miners, which is a sign of a bull market. 2016 and 2020 lows gave us epic buys. I think it is time again now in 2024. The move has already started. Do not miss it. Gold and silver have already had their historical breakouts. Remember that. So this is SILJ versus GDXJ. And we've got these big outperformance moves, and we're in that move right now. It's already underway, and we're just doing a back test of a double bottom. So we have an expanding falling wedge, very bullish pattern that's ready to rip. For SILJ. Here's the DXY. We were talking about the DXY and the weakness and how commodities and precious metals do well when the dollar drops. And when the dollar drops, it generally correlates with a decline in interest rates. So he says, this is Casper, he says, 104 is the last stand here for some time. If that gives in, we are getting a big Bollinger Band expansion with price heading down. And we're right at support here, and we'll see if we break it to the downside. This could be a big move or a drop in the dollar, and that's what's going to price all these commodities higher, is the drop in the dollar and the relative drop of the DXY. So JC Parrott says, remember, when this wasn't a bull market because small caps weren't participating. How about when the small cap indexes are making new 30-month highs? So now is this a bull market? Well, the Russell 2000 making 30-month highs, the same with the S&P 600 making 30-month highs. Not sure, but we could see the indexes go up just because the dollar is going to be that weak. And nominally, it gets hidden. Any slowdown gets hidden nominally. So that we could get real slowdowns in the market. But nominally, we still go up because the dollar is just that weak. The current AI bubble is bigger than the 1990s tech bubble, says Apollo. So the current AI, and they're using that with the 12-month forward PE ratio. We look at PE ratios, we've got 2024, it's way up there. That's the top 10. Excluding the top 10 is here, and excluding the S&P 500. So when looking at this, we can look at the last peak of about 2000. We are higher in 2020 and 2024. The peaks are greater in price to earnings ratios than 2000. This is 3,300 comes next, says JC Parrott's gold futures of the cup and handle. And then he's got a price projection of about $3,300 right here at 261.8% of the Fibonacci extension. So here's URA, zooming out on the uranium miners, looking back an entire decade on this cup and handle. Now, I don't think this is a cup and handle. Cup and handles are generally continuation patterns, so you have to enter it coming upward, like this one. This is a cup and handle. But usually they're not bottoming patterns, but you could say this here is a cup and handle there. So this lead in here, you hit your resistance, comes up, and really all the pattern is you're just hitting resistance, and then you don't come back as much. You don't fall back as much, and then eventually you break that resistance line. That's really what it is. It's not so much about the pattern itself. It's just about hitting resistance and breaking through resistance. That is basically all the patterns are, all of them. A falling wedge is a determining factor of buyers equaling sellers, and then eventually breaking the trend line where you've broken that resistance psychologically. So all of these are just psychological resistance levels that you're breaking at the most simplest terms. And you're gauging some of these patterns by how far they fall back against that psychological resistance. You hit it, you fall back, you hit it, you fall back less. And you could look at this and the patterns don't have to be as clean if you understand the psychological herd mentality behind it. They don't have to be clean patterns to work. You can have ugly looking patterns as long as you know that you're falling back less and less and less, and that the resistance level is breaking down. So here's Joel Greenblatt. He says, unless you buy a stock at the exact bottom, which is next to impossible, you will be down at some point after you make every single investment. Your success entirely depends on how dispassionate you are toward short-term stock price fluctuations. Behavior matters. Totally agree. You will be down in every single stock at some point because you cannot buy the exact bottom. Peter Lynch says there are substantial rewards for adopting a regular routine of investing and following it no matter what, and additional rewards for buying more shares when most investors are scared into selling. That's where the substantial rewards are at. But that's what I've got for today, guys. I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. We still have that May Day coupon code going on. And that's all I've got for today. So we'll catch you next time. This is Finding Value.